Hey, Robert, looks like we were wrong again.
Oh no, not again.
So, your sales projections came pretty much right on the dot. However, it seems we were a bit pessimistic on the price, and the price was in fact 5% higher than what we anticipated.
Between the two, yes, there was about 5%. Yeah.
All right. So, in this episode of Real Estate Chat with
John de Perez.
and Robert Eid, we're going to look at why the prices came in, the average price for the Toronto Regional Real Estate Board came in a bit higher than expected, and what this means with the overall real estate market. We're going to jump into Robert's charts here, where we're going to use the actual numbers, not the projections this time. And we'll start with crediting our colleague Ron Hoth with his charts here that show. I'll let Robert explain what it shows over a long term. But Ron Hoth, www.torontosbestdigs.com. Shout out to him. Robert, take it away.
Yes, so what we're going to look at here is the things that nobody else pointed out. And this chart from Ron, because it goes back to 1990, and it shows the months of inventory, which is each one of those individual months inventory at the end of the month, divided by the number of sales in that corresponding month, giving months of inventory. So nobody can imagine what it was like back in 1990. I would love to be back in 1990, but I can't imagine it. And this long chart, like all the time I say the real estate market started again in 1996. I say we're 25 out of 28, because there's the cutoff there. There's where normal sort of started again after that calamity of the 90s. But we may be, ding, you may be in the 90s again. You just don't know it till next year. So this 1990 perspective shows you everything that has happened. No, we don't want to talk about the 80s. No, we don't talk about the 70s, but it's the same repeating. How does a government try to run the economy, deal with inflation by raising interest rates, and does it work? So there's 1990. We got the next one, which is the same thing, except for a shorter period of time. This goes to 2007, sort of allowing for this global financial crisis. And we see there in late 08, we got up to 8 months of inventory. So inventory accumulates because it's not being gobbled up. That listings are put on the market for 3 months, 6 months, longer periods, and do not sell. And during that period of time, a few nibble away, but all the time you got more building up, more than get nibbled away. So we have seen this go down, we've seen it go up. The last time it went up was right after the arrow is the lockdown. Nobody knew what was happening then. Nothing sold, and so the ratio went up, and then fell down to just before the boom in 22, and then it's gradually been building up. We had the surge that brought the number of sales up and the ratio down, and now we're back building up to where we've broken through 4 months of inventory for the first time in a long time. Now, the reason I use inventory rather than the long-standing sales to new listings is something we'll get into later. This is a number you can't cheat about. It was the number of sales, it was the inventory on the books, and this is the number of months. So from here, we go into our look. Okay, the Toronto Real Estate Board does use sales to new listing ratio. Now, the black bars in this chart from the board show 28.5% of the what they call new listings sold in the course of the month. Now, the average for this, 10-year average, 5-year average is 51.1, 51.3%. So I'm going to say it's 51% is what the average is. So we're 44%, I'm sorry, below the average for September. So this is astounding. This is astounding. Nobody's making a big deal of the sales to listing ratio being 44% below normal. How come? Because the market doesn't seem to be behaving that way. Let's go to the next one. Now, the next one is where we see how a new factor that didn't exist 20 years ago, didn't exist too much 10 years ago, but it did, existed 5 years ago, but it went away, came back, is this idea of terminating a listing and then putting it through again. And because it's a brand new listing with a new contract signed by the owner, it's a new listing, and so it counts again. But in this most recent month, there was 4,467 of them. Now that doesn't sound a lot compared to the 16,000, but you got to subtract that 4,467 from the 16,000 to get the real number. So it was 27.5% of the total they got, 16,258. But that, you subtract that away, 37.88 is the amount that they're boosting up. So this chart in the black shows the adjusted number. So the sales to new listing ratio by the standard method, we talked about it in the previous thing, was 28.55% sold. My goodness, terrible. Now, if you take out the relists, it still comes to 40%. So it's definitely in buyer's territory, but just by a smidge. Like we had this debate last week. What is it, 40? Is it 45? So I've switched to 42.5, make everybody happy. So we're still in buyer's territory, just by a smidge. We're not in balance. We're in buyers. We're not in sellers. We were in sellers. So it's not as bad as it seemed, because as we look at 905 and we look at 417, there are slight differences in those two markets, the customers, the sellers, and the buyers. So away we go.
So Robert, for our new watchers of Real Estate Chat, and for anybody who hasn't subscribed yet, make sure you click subscribe. We're talking about a lot of terminology, and for those of you who've been watching previous episodes, you understand what months of inventory sales to new listings ratio is. But we're not going to go into pure definitions of this. But essentially, Robert, what you're saying in this chart is because of the fact that the terminate and relists inflate those numbers, the measures by which you use to measure sales to new listings ratio, which essentially means how many new listings or how many sales are there compared to the number of new listings that coming into the market, it's pretty much overstated. But regardless of these two, we're still in buyer territory.
That's right. For the first time in a very long time. Look at the last time when that, well, either number, but the black number particularly, when was it below that bottom?
It's been a while.
Not anywhere. We go back to 19. That's not very far, but the thing was too crowded before that. So it's not very often, maybe in a January or something or other. Okay, so now we switch over to sales, because the component of inventory, we know what that is, it's listings. New listings is what's new coming on the market. And sales is what is being accepted by the buyer, and a price is being agreed, as offered is being agreed by the seller. So we've said this all the way along. It's a lousy year. We're the 25th best September since 2008, when the real estate market started again in 1996. And it's been this way all the way through, except for those couple of months when it was only the 14th best or the 20th best of that individual month. So it's still chugging along. There's a certain number of sales that will always happen, no matter whether it's a war, it's the middle of winter, there's an election on, no matter what the factor, like everything affects real estate. I don't know anything except for how it affects real estate, because that was my whole training. My whole training was, why is I'm having a problem with buyers? Why am I having sellers? And I tried to find the reason. So here's our chart, which shows us we've been trucking along the bottom of the barrel, but we're still trucking.
Now let's look at the, remember,
composition.
We're in the fall. Yeah, we're in the fall season. Typically higher price homes sell. How much did that bring up the average price?
Well, we can't exactly say. All we can say is that $2 million, well, $2 million is not what it used to be, but there was a higher percentage of $2 million over houses that sold in this last month of September than it was for a couple of months. It was surging when it was surging, and then it was down. Then we saw where this whole chart is about that portion of time between September 21 and June 22, which I'm calling atypical, when it was above the 3-year average. Now we are back up and above the 3-year average, or 7% of the market is over $2 million. Now, here's the beauty of inflation. Everybody who wonders about real estate and whether they should buy it, inflation makes your tangible asset more valuable in the numbers, in the dollars that we work with in this country every single year, be it 2%, 5%, 9%, 35%, scarcity, supply, demand, everything makes it appreciate. So $2 million is not what it used to be, but what it used to be is never selling this well. Okay, so here we break down 905 and 416. So the big surprises are not the big surprise. The September sales in 905 fell by 11 a bit percent versus staying nearly flat in 416. So what failed in 905? And that's comparing it year over year. The prices in 416 did go up by 5 and change, where it was a little less than 2 in 905. And if we jump from this one to the next one, it's a variation on that theme in that it shows the breakdown of sales by type: detached, semi-detached, townhouse, condo, apartment in 416 and 905, and compares it to the year before. That in this chart, the bottom half is year to date. Year to date comparison, year over year, every single one of them is negative to a year ago. The price is lower, the sales are lower than a year ago. If we go up to the top and we compare September to September, detached is higher in 416 than a year ago, but a lot of red all over the place. The prices are up except for in condominium apartment. So nobody is shying away. It seems the people are not shying away from the houses that sell for the most. Because if you have money, you do what you want to do. It may be, as they were saying on the news the other day, it's time for the buyers to get a little revenge. And many times, especially in the price class of 1 point some, they've got some to sell, so they're both a buyer and a seller. But it's a market that doesn't make any sense. If the sales are off by 40%, everything's off by 40%, but the prices are up, then what is that about market behavior that it tells us?
So Robert,
Well,
that's sort of what I was going to ask next is that how does this make sense, or why doesn't it make any sense? Because will we see, for our viewers who are anticipating the 2024 market, are we going to possibly see, is the whole price movement downwards or pressure that everybody's calling for, is that lagging what's happening right now? What, like, sales are dropping, fewer people are buying, it's costing more to borrow and it's costing more to live. How does this make sense that these prices are holding?
Okay, well, if the average price in Toronto was 1.1 and the detached house is selling for 1.7, then that means that they're not subject to the influences that the people in the rest of the price ranges, the ones that are under the average, are susceptible to. So the threats there of being kicked out of their rental aren't there. The threats of losing their house because they can't quite qualify for it because they're going from 5% to 7%, then going 2%. Stress test is not important to them. They got half down, they got more down. So it makes perfect sense on an individual basis. When you try and mush it all together, it's what we say about seasonally adjusted numbers. Nothing makes sense when you lump them all together, because one bad apple you don't see in the barrel. So what do we say about the future? We say watch. What we know from general is that it's a time for caution. It's a time to dispose of assets that you're not using. If you have a condominium apartment that's underwater, dump it. If you have a 2-story that's broken into 3 flats and you're renting it out to students, well, maybe it's making lots of money, keep it. But only you can decide whether that's the best use of the equity, the amount of money that you have invested in there over top the mortgage. So
now let's look at this one, Robert, because what we called on our forecast episode was the dip of the price between 2022 and 2021, when in fact it actually ended up somewhere up here. So
yeah, we fell down in between 2 years ago, but we're above where we were a year ago. So is that good? Well, it's following the trend. Does it have anything to do with 2 years ago? No. So we tried to do a chart that showed that a couple of months ago, but it doesn't mean anything anymore because the way I started it in September, unless you've got the whole year, you don't really see it. But here it is. It's in between the two. This year is in between last year and the year before, which happens a lot. You wish it was over top of all of the years. It was the best number ever, but it's not. And what we didn't take into account before we made our projection of off by 1.5% was at looking at the last 20 years. So we look at the last 20 years, and normally in 20 of the last 21 years, the price went up in September over August. Again, it's the property mix, and it's the let's buy before the snow flies rather than can we get into something before school that might happen in August.
It's
So
also the percentage share of the prices, as you pointed out, Robert, that would have pushed this up. Is it because of the higher priced homes that have been selling? But
yeah,
is this enough to be confident about? Like, so for everybody watching, should they be confident realizing that, hey, wait a minute, maybe the worst is already past, and maybe this pattern is just going to
no,
repeat?
no, no. Like I already called this once wrong in May because of the statistical thing I was following on the Treb, and it changed the dates and made me see that the prices, or rather the number of sales were falling. The prices weren't, but the number of sales were falling. So I'm not going to say the market's over, but I think that we are duplicating 1990, the spring of 1990, coming up in 2024. Nobody wants to say bad news, but that's why I'm saying what I'm saying very subtly. If you've got extra real estate, you're not occupying it for your own personal residence, and it's not making money, dump it, because next year you won't be able to.
Well, there you go. You heard it here first, and time will tell. And watch us well into 2024 and see what transpires next. Let's look at the
Okay, so this is
full year.
starting with September. You see a little bit different chart. We've just finished that red line, and now we've started again. And like we said in the other one, we're in between 1 year ago and 2 years ago. So whether it goes straight or whether it goes up or whether it goes down, and this is sales. I'm sorry, this is prices. Time will tell. I think the best flat is the new up. So if it goes straight across and we're still over $1 million by 1 year from now, which is a fiscal year being August, then that's going to be a victory. That's going to be a victory. Okay. The last thing that we look at is seeing exactly how many listings are not really listings. The difference in the red line is the subtracting the relists from the published number of new listings. The number of new listings on average over 10 years should be 15 and a half. 5 years, 15.3. So we're +5 and +6 on the 5 and 10 year average. You can see the little blue dot just barely over. But when you subtract out the relists, which are just the same house, they started getting multiple offer, but it failed. So they put it through again, but it counts, nonsense. Like you made a mistake. You can't count it twice, but they do. That's why the prices are still going up, because there's a shortage of listings relative to the 10-year average. There's not as many, even though they say there's not as many as there were. People are not doing things. They're not taking chances. They're saying, well, let's wait till next year. Our mortgage isn't up for renewal for another 2 more years, so let's just stay here. And they're being Canadian. They're being cautious. They're being prudent. That's why you got to count. You can't count those do-overs twice. Okay, so this is our chart that we're trying to watch into the future. It's going up and it's going down. And we can't say whether it's going to follow the same pattern. Same pattern was it never got to 70%, never got to 30% off the previous peak. It always monkeyed around. The last time that it got this long was through the 80s, as I say, the 90s. And will it follow that pattern? So many things are different between then and now. Think of the number of things that you trusted and believed in and thought was absolutely right that you've lost faith in, and the groups and the professions that you've lost faith in since then. So it's all different. And so a projection there is just a guess. And this is another chart that does it sideways. So that's too much to go into in small numbers.
All right, takeaways from this episode of Real Estate Chat.
40% under in the number of sales, 40% under in the sales to listing ratio, 40% under. What does that tell you? Are we going to see a whoosh up? Or are we in a cautious period? We're in a cautious period. Like if interest rates started going down, remember that's a very bad for everything. That'll mean that employment is whooshed up. They said, oh, gee, 2 months ago, the employment whooshed up. We better do something. We better bring interest rates down. Businesses are closing. It will be bad news if interest rates come down, because they only have one club, and that's interest rates. And they keep on beating everybody over the head, thinking they're going to beat inflation. At the same time, they're giving every civil service union that comes record contracts, changing the benefits, enormous increases in the costs of labor to them. And they're giving away our money on it. Anyway, it's not about the government. It's about what's happening as influences on the stats that the people who are making decisions are looking at. So, in a way, you don't want interest rates to go down because that means it's bad news. but you want interest rates to go down just about the time when your mortgages come up for renewal, so you don't have your payments go through over your head. So what's the takeaway? Everybody's lying. It's just who's lying the worst.
Well, it's going to be time will tell on one of these, because Robert, going into the October month, basically, what are we watching for so that we can sort of get an idea of where things will go? I mean, we've already talked about interest rates in a previous episode. We're watching inventory, and if inventory continues to swell at this level or at this rate, and sales doesn't keep up, will we see price movement go negative at that point?
Yes. Like so far, we're projecting 48.61 for October, but it's only 6 days, not long enough. Last year it was 49. The 5 and 10 year average is 8,200. 8,200 is a long way away from 4,800.
Oh, that's half. I mean, less than or about that.
So it's the 40%. We keep saying 40% is the magic number. So there's a lot of things that are going to happen in the real estate business internally in the next, 4 months, 3 months. We're in the fourth quarter. And then we get the winter. So batten down the hatches. Don't take any chances. Sell off anything that you don't need. Don't take a 5-year contract on a new leased car. Just be careful. Don't overcommit yourself.
Be smart. Do the right thing. Do what's good for you, and keep watching episodes of Real Estate Chat so you're always up to date and informed with what's happening in real estate. Thanks for watching this episode of Real Estate Chat. Take care and bye for now.
Yeah. Bye now.